corporate operations. Let's work through a stock option example. So I'm going to use just years 20x1, 2, and 3 to indicate the first, second, and third year of the problem. ABC Company granted 30,000 NQOs with an estimated $8 fair market value per option. Each option allows the employee or the owner to purchase a share of ABC stock for $5 a share. This is the strike price. We're going to assume that these are 3-year vesting. They're going to vest on the last day of the third year, and that nobody exercised their options in the first, second, or third year. We want to find out what the book tax difference is in each of those 3 years, whether that difference is favorable or unfavorable, and whether it is permanent or temporary. Let's go ahead and turn to Excel. So just taking some of the information from the problem, we have 30,000 NQOs with a $5 strike price. Again, this is what the employee is going to pay on the date that they exercise the option. $8 fair value. This is based on a Black-Scholes model, and it is a best guess of how much the employee will make per share when they exercise that option. And then 3-year vesting. Now we want to further assume that the only difference between the book income and the tax income is this NQO model. So we're going to say that the book income for all of these years is going to be $500,000. So the next question is, how much are we going to deduct? Well, we know that there is going to be 30,000 NQOs, and we know that the fair market value is $8. That's, again, the fair market value is based on a Black-Scholes model, and it's the best guess of what the employee will make per share when they exercise the model. So that is $240,000. That is total. But we want to split this out over 3 years. So I'm going to take this and I'm going to divide it by the 3-year vesting. And that gives us $80,000 per year. So let's then go ahead and grab ABC's book income here for a minute, or figure out ABC's book income. We're going to have, for the 3 years, they have $500,000, and they are allowed for book purposes to deduct $80,000 a year. But for tax purposes, they are not allowed to deduct that. So for tax purposes, they're going to have $500,000, and there is going to then be a difference. The difference is going to be taxable income minus book income gives us $80,000. That is going to be unfavorable, and we can just copy this formula down as well. Now, is this going to be temporary or permanent? Well, it will reverse to some degree when those options are exercised. So this is going to be temporary, and we can copy that down as well. So those are the answers to the first case. Now, going back to the PowerPoint, we have a second example, and that says that on March 1st of the 4th year, employees exercised all 30,000 options at a time when the ABC stock was trading at $14 a share. What is their book tax difference associated with the exercise of those options? Is this permanent or temporary, and is it favorable or unfavorable? So going back to Excel, we are going to add in that there was a $14 price at the time of trading, okay? So this is different than the fair value at the time that it was issued. So we have the 20x4 year here. Now for book purposes, they've already deducted these options. They're not going to be able to deduct any more. But for tax purposes, we are going to deduct the 30,000 times the difference between the price and the strike price. And that is $270,000. In other words, everybody is going to get $9 of profit on this exercise. There's 30,000 NQOs out there. 9 times 30,000 is 270,000. So in this year, we are going to be able to take the 500,000 and deduct the full 270,000, and then we can just copy this across. But is it temporary or is it permanent? Well, we actually have a couple of different pieces here. If we look at the total amount of book income and the total amount of tax income, and we take the difference between those two, we can see that the difference is $30,000, and that is going to be a favorable difference because the tax income is lower than the book income. And now we're done with this problem, so that is not ever going to go away. That is going to be a permanent difference. So if I subtract that, 270,000 favorable overall difference, and we take out the $30,000 permanent portion, we end up with a $240,000 temporary portion. Now this should make sense because if I take this temporary amount and I add all the other temporary amounts that we had, so these were all temporary as well, we come down to zero. And that is also temporary. So we have basically used up all of those temporary unfavorable differences with a temporary favorable difference. Now all the temporary differences are gone, as they should be, and what we're left with is a $240,000 permanent difference. We can also do just a little check here and make sure that we've accounted for all 270,000, and you can see that we have. Okay, I hope that this helped explain how these temporary differences can go in and out, and maybe you end up with a permanent difference. And I also hope that it helped explain these non-qualified options a little bit. This is a good place to stop this video. So get in touch if you have any questions, and I'll see you next time.